India's money just took an unexpected turn. In the first quarter of this year, the country recorded an $8.1 billion deficit in its balance of payments. That's the difference between the money flowing in and the money flowing out. But here's the twist. By June, the trend reversed. Understanding what happened, why it matters, and what comes next reveals something important about how vulnerable even large emerging economies can be to global shifts. Between April and June, India faced what economists call a balance of payments crisis, though not quite a crisis in the catastrophic sense. The central bank reported that the country spent $8.1 billion more than it took in across all international transactions. This breaks into two separate problems. The current account, which tracks trade in goods and services plus income flows, ran a deficit of $3.1 billion. That's the everyday business of buying and selling across borders. But the bigger shock came from the capital account, which tracks investment flows. Foreign investors pulled out $5 billion net. That's the vote of no confidence, money leaving because confidence is shaken. To understand why this matters, think of a country's balance of payments like a household budget. If you earn money from your salary and from investments, but you're also importing goods and paying for services abroad, your accounts have to balance. When they don't, something has to give. India, as the world's most populous country and a major technology and manufacturing hub, normally attracts steady foreign investment. But in April, May, and June, that didn't happen. Investors were spooked. The wider context here involves overseas investors who grew concerned about geopolitical risks. The combination of external uncertainty and higher fuel import costs, India relies heavily on energy imports, created a perfect storm. Two forces collided. First, overseas investors became nervous. Geopolitical tensions, whether regional conflicts, trade disputes, or broader global instability, made emerging markets look risky. Capital that might have flowed into India instead stayed home or went to safer bets. Simultaneously, India's import bill grew heavier. Fuel costs, which fluctuate with global oil prices, rose significantly during this quarter. When you have to spend more money buying oil and other essentials from abroad, your current account deficit gets worse. It's not a problem of mismanagement or structural weakness, but rather of external forces pushing down at the same time. Here's how the numbers fit together. The $8.1 billion overall deficit came from two sources. The current account deficit of $3.1 billion reflects the fact that India imported more than it exported, or received less in investment income than it paid out. That's not unusual for a developing economy still industrializing. But the $5 billion capital account deficit is the alarm bell. When foreign investors, from pension funds to multinational corporations to sovereign wealth funds, collectively decide to move their money out of India, it signals they're reassessing the risk-reward calculation. That's different from saying India's economy is in trouble. It's saying that, at that moment, investors got worried. The good news is that June turned the tide. The fact that the deficit didn't persist into the next month suggests this was a quarter-specific shock, not the beginning of a long-term retreat. When we look at the balance of payments in pieces, the current account deficit of $3.1 billion and the capital account deficit of $5 billion add up to the $8.1 billion shortfall for the quarter. Each tells a different story. The current account is about everyday commerce, how much India buys versus sells, how much it earns from services like software and tourism. The capital account is about trust, whether investors believe India is a good place for their money right now. For ordinary Indians, this deficit matters in indirect but real ways. When foreign investors pull money out, the rupee, India's currency, can weaken. A weaker rupee makes imports more expensive, which eventually shows up in the prices of fuel, electronics, and other goods that India brings in from abroad. It can also make it costlier to borrow money internationally. For businesses that operate across borders, currency volatility creates uncertainty. On the flip side, a weaker rupee helps Indian exporters by making their goods cheaper for foreign buyers, which can boost manufacturing and jobs. The broader meaning is that India, despite its size and potential, is not immune to global sentiment. Money is fluid. When investors get nervous, it flows out. When they gain confidence, it flows back in. That's why June's turnaround was significant. It suggested that the geopolitical anxiety was not deepening. The fact that June alone shifted from deficit to surplus is crucial. If we're talking about a quarterly deficit of $8.1 billion, but the last month of the quarter moved into surplus, that tells us two things. First, the worst was in April and May, the peak of investor anxiety. Second, conditions stabilized quickly. This is not like a sustained crisis where money leaks out month after month. It's more like a panic that reversed. That kind of volatility is uncomfortable for policymakers and investors alike, but it's less damaging than a structural problem that would take years to fix. The central bank would have been watching this closely, likely taking steps to support the currency and manage outflows. India's policymakers face a balancing act. They'll want to attract foreign investment back by demonstrating stability, but they can't simply ignore the structural issue of rising import costs. The central bank has tools. It can adjust interest rates to make rupee deposits more attractive to foreign investors, or it can accumulate or use foreign currency reserves to stabilize the exchange rate. On the trade side, India will need to either increase its exports or find ways to reduce import dependency, a slow process that might involve boosting domestic fuel production or renewable energy, or expanding manufacturing so that more goods are made at home. What won't work is hoping that geopolitical tensions disappear. The world remains uncertain. Capital flows will remain sensitive to headlines. India's job is to make sure that the next time global anxiety rises, investors see enough strength to stay put. The good news is that June already showed it's possible. India recorded an $8.1 billion balance of payments deficit in the April to June quarter, because overseas investors pulled back amid geopolitical fears, and because fuel import costs were high. But the story didn't end there. June turned positive, suggesting the panic passed. What this reveals is that even for a nation of 1.4 billion people with a large, diversified economy, the balance of payments is a sensitive meter of global confidence. The lesson isn't that India is fragile, but that it's connected to the world's worries, to oil prices, to investor sentiment. And that means what happens next depends not just on what India does, but on whether the world outside grows less anxious.